Welcome to the DeFi Standard. This is Patty XRP, and today we are going to continue our Polkadot Parachain series, which is highlighting some of the potential projects that will be vying for Polkadot Parachain slots here in Q4 of 2021. And today on the docket, we have Equilibrium, which is going to be the first decentralized interoperable money market protocol. Additionally, they are introducing a cross-chain money market that combines pooled lending with synthetic asset generation and trading. And to kick this video off, let's go ahead and start with the tokenomics of the native asset of the Equilibrium protocol, which is going to be EQ, or Equilibrium token, and it's going to act as the utility token for the Equilibrium parachain, which will be used for the collection of fees in DeFi applications on the network, validator rewards, and it can optionally be used as collateral for DeFi projects, and this is not mandatory. However, so they're assuming that some of the EQ will be used for collateral in their ecosystem, while some of it will not be, and that kind of goes into their whole token modeling. They compare the functionality of the EQ token to the Maker token from the MakerDAO DeFi protocol, as well as to Ethereum, as its function is used with the main DeFi blockchain. And additionally, they'll have a 2.5% annualized inflation rate that kind of takes effect once all of the tokens are distributed from like the Parachain loan offering and things of that nature. Now, getting into the token allocation, about 10% of the supply will be utilized for liquidity farming, another 10% for the Parachain lease offering, as well as 5% to their investors. 25% will be utilized in their token swap. So this is something important to note, that Equilibrium originally launched a project on EOS where they had a collateralized stablecoin called EOSDT. And with that, they used a token called NUT. I'm not sure what the full name of that is. And they were allowing users of that previous protocol to swap their tokens, their NUT tokens, for EQ tokens at the applicable swap rate in order to participate on their new protocol that will be going on a Polkadot parachain. And then additionally, the team's getting 15%. They're going to have a treasury that's going to have 35%. And this has something called a stability fund in it, which is interesting. And we'll get into that a little further. But in total, this is going to bring the supply to 57 million tokens, and those will be distributed over time. So with that, on the time part, so liquidity farming, that will go on for about a course of 3 years. And then you also have the tokens that are coming out with the Parachain loan offering, which we can kind of touch on a little more. So with their vesting, the Equilibrium team will have a 2-year vesting period, and their token allocation will gradually be released during this period. Institutional investors will have a 1-year vesting period, which is gradually released during that period. People that took part in the token swap have no vesting period if they held it before August 1st. And others can claim 10% of their allocation right after the token generation event, and 90% are subject to a vesting period of 1 year. With the Parachain loan offering, they will have no vesting period. So to me, that tells me if you bond DOT behind this Parachain, they win a Parachain slot auction, that you will receive your full allocation of EQ tokens for that immediately after it launches its Parachain on Polkadot. And then you would receive your DOT tokens back at the end of the lease period. So that's how that would work. Now, with this, I mentioned that Equilibrium originally had a project that was on top of EOS, and EOS will be integrated into this Parachain protocol. But essentially, they had something called a stability fund, which currently is at almost $21 million worth of EOS. And this is stored by their treasury and used as like a last last-ditch effort to save the solvency of their platform in case all the other precautionary measures fail. So that's kind of cool that they have their own little like slush insurance fund that can help capitalize users in case of some like severe adverse effect. And they also say here that they have launched the industry's first stability fund, and it was originally had $17.5 million worth of insurance, which you can see has grown since then. There will be several functionalities on the Equilibrium protocol, and this includes lending of all main crypto assets and EQ tokens, borrowing all main crypto assets, decentralized stablecoins, and synthetic assets. You'll additionally be able to stake proof of stake and delegated proof of stake crypto assets and the EQ tokens, and you will be able to trade via a DEX. All of these assets, the stable coins, the synthetic assets, and the EQ tokens. So we can see here some of the connected blockchains. So we'll have like Ethereum, Tezos, EOS, Bitcoin, Binance, Cosmos. XRP is another one that's being planned in the future, so that's cool to see. I am curious with how they do their bridge with the XRP ledger currently, as it kind of involves smart contracts. So if that's something that will come about as hooks or the XRPL sidechains amendment get passed and implemented, but we'll have to see. It's definitely on the roadmap, and that's kind of exciting to me as an XRP holder that I could possibly use synthetic XRP to either hedge my portfolio or get additional exposure to XRP price volatility. Some of the benefits of this protocol is that a lot of your DeFi use cases are all going to be in one place via their interface. It'll be cross-chain enabled. As we were talking about earlier, they're going to have many bridges that they'll use. And as more bridges get built out throughout the Polkadot ecosystem and on other parachains, they can tap into those as well. That's kind of part of the benefit of being a parachain on the Polkadot ecosystem. Additionally, they're going to offer the highest possible liquidity solution. So a popular synthetic asset protocol is Synthetics on Ethereum, and they have extremely high collateral rates of, I've seen like 700 to 800%. They're going to be very low on Equilibrium, which I think is a plus for them, and they have an interesting way of kind of keeping the entire system solvent, which we'll touch on later as well. And then additionally, they're going to do bailouts rather than auctioning off liquidity. So it ensures liquidity against debt default in adverse markets. So with this, they have a 3-layer proactive system solvency protection. So they state 70% of solvency issues are predictable, which is covered by over-collateralization, and they have determined that 110% is the LTV ratio that you need to have. So that's really low, especially compared to synthetics, which is pretty popular on Ethereum. Additionally, for the unpredictable 29.9%, they have these groups of people called bailsmen, which take over debt obligations in case of margin calls. So that would be when, let's say, a user's borrowed like 100 ETH or something, and their collateral position is maybe 95% of the total value of that ETH. Well, they're below the collateralization ratio. And so in that case, the bailsman would take over their assets and liabilities and earn interest for doing so. And then additionally, for the less than 0.1% of extraordinary cases, like I said, they have an insurance fund, which they call their stability fund, and it will have $13 million to start with, and will expand as more people use the protocol and more fees are being driven into the system. Here's a little ecosystem infographic, which shows that you'll have lenders, borrowers, traders, and bailsmen. So lenders will supply crypto liquidity for lending into the cross-chain money market. They'll receive interest in return. From the way they describe this, the lending is basically risk-free, as they will give you stable coins equal to the value of your lent crypto if it's not paid back. And that can be used to repurchase the crypto on on the DEX or somewhere else. You could go to a centralized exchange or something like that. So the interest rate for lenders should be lower than the bailsmen. But the bailsmen are basically the people that are taking on more risk as they're absorbing bad debt and liabilities of borrowers in case of default. So they secure the loans in the system to make sure the entire system doesn't become insolvent due to lack of collateralization and its risk getting too high. Additionally, we're going to have our borrowers. They borrow crypto assets and synthetic assets and pay interest to the cross-chain money market. Their interest rate is going to differ per person and is based on how many assets and liabilities you currently hold. So like if you have a borrowed asset, that's a liability for you as you're going to have to pay that back and it's not yours. Additionally, they'll be looking at collateral levels. So the higher your collateral level, the lower the APR you'll be paying on this, your borrowed assets. So that's interesting, and it's something that doesn't lock everybody into the same interest rate. So it's based on individuals' like risk profiles and how much collateral they want to put up. And additionally, we'll have traders that can trade assets via their cross-chain DEX. It utilizes some like off-chain workers to avoid any kind of fees being paid for just posting like a limit order or anything like that. So I think that's interesting as well. After reading through the Equilibrium documentation and white papers, one of the most interesting things to me is the fact that they're going to be algorithmically setting a lot of the parameters for the ecosystem, like collateral ratios, interest rates payable, and various things like that. And so with this, they kind of talk about how they're going to have no arbitrary governance set interest rates. They're determined by a borrower's portfolio, their debt, overall system liquidity, and the market's risks and dynamics. There are also no arbitrarily set LTV requirements. The system makes sure every position remains solvent at the 100% collateral ratio. Additionally, there are no arbitrary set liquidation penalties and no hidden fees when borrowers default on their loans. So you'll know, like, if you do default, what will happen. And there are always two sides to the system by design. Lenders and bailsmen are the liquidity providers on one side, and borrowers live on the other side, paying fees to lenders and bailsmen in order to get access to more capital and assets. So with that, they'll have the asset lending, a fractional reserve system for synthetic asset creation. They'll also have an exchange with leverage trading and the ability to do portfolio hedging. Here's an example of what a potential balance sheet could look like for the ecosystem. And as you can see here, there's about $20,000 worth of Bitcoin as a positive balance with $4,000 worth of Ethereum and 6,500 US dollars as negative balances. So these are borrowed assets. However, this is about $11,500 compared to $20K. So I'd say their LTV is around 190% here, which means the system is, more than collateralized. It's very solvent. It's not risky at this point in time. And with that, they said their risk and pricing model allows for an LTV requirement of 100%, but due to block time and price oracle limitations, in practice, we risk having untimely market data in the event of abrupt market decline. So that could be stuff going offline and maybe prices not getting there quick enough. So they have the LTV set at 100.5%, allowing for a 0.5% wiggle room for possible delays with some of the things they're touching on there. And so additionally, they touch on, the lending approach with classical DeFi compared to Equilibrium. So in classical DeFi, so this would be on Ethereum, you would deposit an asset, flash borrow additional assets. So this is via something called a flash loan. You would then use the asset as collateral to generate stable coins and go to a DEX and buy an additional asset with those stable coins and return the flash loan. So that would kind of be the process. However, here you can just deposit an asset and then exchange USD, which would be gaining a negative balance in USD for a positive balance in an asset that acts as collateral instead of going through that whole kind of process, which is a lot. Additionally, with their risk model, we can see here a case where there's a borrower that has $1 in debt. Who knows? This could just be dust living in his account that they don't even know about, compared to 500K in collateral. So their LTV is basically 500,000%. Or I guess that'd be 5 million actually. Multiply that by 100. And then we have a borrower that's also in good standing at 125% LTV, but they're much more active in the system. So they say it makes no sense to include borrower one's collateral and debt into aggregate values when calculating system risk, as this position is virtually risk-free and would lead to improper calculation of insufficient collateral. So they exclude situations where the LTV is just super high and it doesn't seem like it's actually somebody using the system in the way that others would be, where they maybe have 100% to like 500% collateral. I don't know the exact rate, but that's something they will be determining as well. And to touch on the bailsmen, or these bailout pools that take over when the system starts failing or people are defaulting on their positions. So these bailsmen provide liquidity in advance to cover for borrower liquidation. So they put liquidity into this pool, and then when borrowers default on their loans, their collateral and debt get distributed among bailsmen on a pro rata basis. So the only way they're able to get negative balances is through borrower liquidation. Furthermore, no bailsman can stop being a bailsman unless he covers all of the liabilities he has entitled to. So let's say you put $100,000 worth of liquidity into the bailout pool, and let's say something happens where now you have maybe via the liquidation mechanism, you have 150K in assets that have been distributed to you, but now you have 175K in liabilities. Let's say somebody got super under collateralized for whatever reason, and the liquidation didn't go well. Well, now that person would have to pay off or add assets to it so that the bad debt's covered on the liability side, and they're at least equal, or the asset side is higher than the liability side. And for that, making sure the system stays solvent at all times, they are going to receive interest rewards for bearing liquidation risks, with 80% of the interest rate that the system collects from borrowers going to the bailsman, and then the other 20% accumulates inside the treasury and is used as a third line of defense in case the bailsmen themselves become undercapitalized. So that's an additional thing if you're a bailsman. Like, let's say that situation happened and you didn't have more assets to put in. Well, the system has that stability fund, which is the failsafe that will come and recapitalize you so you can take your assets out and no longer have to be a bailsman. And to add at the end here, the EQ token, like many other projects launching on Polkadot and many other blockchains at this point, are going to have governance functionality with the EQ token that goes over like parameters, protocol updates, and things of that nature. So that will be available with the EQ token. And then additionally, you can stake with their collators on the network, which are batching transactions and creating blocks to send to the Polkadot relay chain validators so that they can be included in the consensus of the Polkadot ecosystem. So that will be available as well, and you can participate in that just like you would any other parachain. Additionally, I'm kind of, what excites me most about this project, and it's something I'll be watching, is the fact that we're going to be able to get synthetic assets, which can be used for like short selling, hedging, additional, price volatility exposure. If you think an asset's going to move up in the short term, you can also borrow an asset to sell it short if you're moving it down. So I think these are things that are needed in the DeFi space, especially since they're available in traditional finance. And then, with that, some of the other options out there have really high collateral ratios. So with them having 110% starting collateral ratio, and then basically the 100% LTV before liquidations, I think that is pretty powerful, and we'll see how it works. I'm going to be more curious to see how they're doing their whole Oracle system, and if they're using some of the Oracles launching on other parachains, if they have their own solution for that. That'll be something to watch, because obviously if the Oracle's centralized, then that involves a whole host of issues with synthetic assets if they're not being priced appropriately via the Oracle, but definitely something to watch. And I'll be very excited when they get XRP incorporated, as there's not a lot of synthetic asset opportunities for XRP out there. But yeah, that's going to wrap up this video. It was all about Equilibrium, the cross-chain money market for DeFi coming to Polkadot. And with that, this is the DeFi standard, and I am out. See you guys.